No expectations. No expectations? You can't waste 3 hours of your day to come here without expecting something useful. Yeah. Yeah. Investor criteria. Yes, please. Okay. So requirements. One more. All right. As we did last week, I request that we all turn off our laptops or shut them. Sec that we listen to each other, have a conversation. Hopefully we can be more efficient and then we can get back to work. All right. It's a very narrow list, so it makes my work easy. And I hope for those that didn't have expectations, at least you get value from the session. Who of us here has made an investment? An investment into another company or another business run by someone else? Any volunteers? William. Is it a debt investment, equity investment? Both, okay? That's good. William, debts. Today you're going to be a co-facilitator. Who else? Who else has done an investment? Who has lent money to someone else running a business? Yeah. Perez. Was debt. Any other investor in the room? All right. So I asked that because I would like to hear your experiences as we go through the session, right? Specifically, what you looked at and what your experience was. So we'll be engaging. All right. So today is not a game as it was last week, but I want to make sure it is as engaging. I want it to be a conversation, right? Because we all have some experiences. Either we've worked or supported a business that has tried to raise money, right? Or we've actually invested. Now, you may not have invested in another business, but you may have put your own money into a business that you've tried to run. That also qualifies to be an investment, right? So we want to bring those experiences together to try and understand how investors make decisions, because it's usually not so different from how we make our own investment decisions. And in most cases, we assume it is different, and I think that's why we struggle, right? So the session has two sections. One, will first talk about the landscape in terms of how the investment landscape is and how investors operate. Then we'll go into the details of investment readiness, which was the main purpose for today. So as we all know, there is a lot of activity right now in the region in terms of investment. A lot of money is flowing into the region. In the media, we are seeing several people raising millions, and that creates excitement, right? And it's one of the reasons we have a lot of entrepreneurial activity, because people think now it is easier to raise money, So it should be easier to start and run a business, right? So statistically, we've between 2007 and 2018, which is the most recent statistic, we had about $3 billion flowing into the region. Now that's a lot of money, right? To sort of understand the kind of impact such money would have on an economy is to think about oil and the excitement we have around it, right? It is the same kind of money we are talking about. So this is money that should actually have a very strong impact on the economy, and almost everyone should feel it. If people are raising money, it should actually become easier and easier. And the question is it actually becoming easier? The answer could be yes, but not as much, right? Because we are not really feeling it, especially when it comes to local businesses. And the reason is most of this capital is either going to very specific countries or very specific types of businesses. And those businesses are mostly expatriate-led. They are led by Bazungu, to be direct, right? Now, it is easy to think that, okay, maybe it is color. And I used to think the same until I crossed the other side, right? So there must be something that is driving, because you can't leave the US to come and invest here and you find your portfolio is 100% expatriate and you're comfortable. There must be something that is taking you that direction, right? Which is what we want to understand. In terms of countries, it is either Nigeria or Kenya or Egypt, and I think most recently Uganda is trying to pick up, but we are far behind, right? When Kenya raises $800 million, we raise 80 million. So Kenya is about 10 times ahead of us, right? So we need to try and if you think about it, Kenya has a very heavy expatriate community. So even within Kenya, we cannot say that the local entrepreneurs in Kenya are happy. So that is the statistic that is skewed, that we need to understand why is it happening, right? Why is that happening? That is one. Just take note. We'll look at that. We'll refer to that again. The second thing, again, for clarity, is usually the question is, what kind of money, right, should I look for at what stage, right? And this is a quick slide again. Businesses go through multiple stages. When you start a business today, we call it an idea because you don't have any traction. If it is still on paper and before you make your first sale, you're simply an idea. And most businesses start there. I mean, all businesses start there, but when people say Uganda is an entrepreneurial community, most businesses are actually ideas. And many of them do not go beyond that. Everyone has very good ideas. When you're walking through town, you see an idea every minute, right? And then they are profiling in the Pakasa, they are giving you examples of successful people. Then you are like, even me, I can start that one. Especially the corporates. When you are in office, you are like, I'm tired of working for someone. I think I can also run what? A business. So ideas are so many, right? Of course, when you move from idea, then you go to prototype, what we call prototype. This is more clear in the tech world. Because when you have an idea, you don't just go full scale developing, right? You have to start and test things and see how they work. The challenge always is the day you start business, right from day one, you need money. There is no question about that. And I always hear advisors tell entrepreneurs that you don't need money. That's not true. It's not being empathetic. You actually need money from day one. Because even if you want to go and interface with your customers, just have a conversation to try and understand their needs. That is transport. That is money. The question is, where is it coming from? Right? So at idea stage, the fact is, if you don't have any form of savings, you're doomed. Because that's when nobody wants to, because you're just starting. So the person that is going to give you money at that point has to trust you as a person. In fact, this is the point when a conversation, 30-minute conversation should be enough with an investor. because you don't have any traction. It's about you. So if you're selling yourself at this point, or if you are talking to an entrepreneur, you really need to encourage them to sell themselves as a person, right? And we'll look at what does that mean. What do you sell? But it's about you as an individual, right? Of course, we have so many competitions now between idea and prototype. There are so many competitions, right? And some of them are becoming success stories before they even go past that, because they are always pitching. They're in every competition, right? Which is okay, as long as they're able to move past that stage. So competitions, again, friends and family, what they call bootstrapping is possible, but very difficult, right? Because the idea of bootstrapping, like we ran our business, is that you need to start generating revenue from day one, right? And make sufficient profit for you to actually continue running and reinvesting into the business. I think we saw that on the board last week, and how you are able to achieve that. You have to be able to sell, you have to manage your cash flows well, right? So we saw that last week. And then, of course, hubs. You are all hubs. So at this stage, if you're working with ideas and you don't have any form of money to give them, you're really not finishing the cycle of helping them. Because the day they leave is the day the ideas will die, right? So if you're running, and me, myself, personally, I usually stay away from programs at that stage that are not giving any form of money. Because in this market, you're not helping that entrepreneur. At least give them $500 and tell them, this $500 is for you to talk to your customers and prove that they even like your idea, right? If you don't, you're training, you're basically creating, transferring knowledge. You're not creating businesses. And that's the truth. Like I said last week, the day you graduate or leave school, you have a lineup of dependents. So there's just so much pressure that even savings is not a strong option for most entrepreneurs here. That's why it is very important. If you're designing a hub, you'd rather cut your expenditure and have a small budget to finance and give these entrepreneurs at that stage. Because again, like I said, not many of us have rich uncles, which we would call friends and family. Not many of us are able to save because of the reasons. These are the realities of this country. Yeah? So if you're running a hub, you really need to be in touch with this reality. That's why once in a while, I'll remove my glasses and just go downtown. Leave my car, everything, be normal, and go downtown. Walk around just to understand the realities. Because the challenge we have, most of us who are advising businesses, that we are detached a bit from what? Reality. So I'll either go downtown or go work with a business as their employee, even if it's just for a day, in a quarter, because you get to understand those realities. Anyway, so beyond prototype, you start to get some customers, like we did in our game. At that point, when you start to sell, you start to look attractive to some investors, external investors, right? Those external investors are usually individuals, which we call angel investors. Yeah, an individual like me. It is easy. I don't have a process. I decide it's my money. I could even decide, within an hour and say, I'm going to give you money because you've proven that this idea works. And then again, accelerators have a role to play here, especially those that have some funds they are running, because they have worked with the business during the program or whatever training. They're able to trust that entrepreneur quicker than another investor would. And then there are a lot of VC funds that are going earlier and earlier because of their experience here, right? Later on, as you progress, then you start to look at what we call private equity funds, banks, and for-profits, other corporate entities, right? Question? Yeah, we should ask questions as we go. Yeah, we are going to talk a bit about traction. But like you said, it varies. Depends on the investor and which person you're. But I would like to just pause that. I'll refer back to that. Right? Uh, Now, there are different forms of capital. I think we all know. The more traditional ones are debt and equity. Those are known, right? Um, and this hierarchy starts with dilutive types of capital. Dilutive means when someone invests, right? If you've been owning 100% of the business, your share is going to what? To reduce. So that is what equity does. When basically someone is buying shares into your business. So at the bottom, right? So as you move up towards debt, the dilution becomes less towards zero. There is what we call a convertible note or convertible instrument or convertible debt. Like it sounds, it means this starts as a different instrument and then it converts later into something else, right? So usually it starts as a loan and then it converts based on certain terms to equity, right? And that is a very common instrument right now. The reason why it's common is because people try to stay away from equity for various reasons we'll look at. It's actually around the structure of funds and how they operate that forces them away from equity from day one. Because the moment you say you are going to buy shares in my business, it means I need to know how much or the worth of my business. I need to know that my business is 100 million shillings. So if you're giving me 10 million, the value will grow to 110. Then we can calculate your share. But that's not easy, right? To come up with the value. Is it? It's not. Usually people will just have, if you ask entrepreneurs, of course, they usually have crazy numbers. Someone will have a business plan and tell you my value right now is 100 million or $10 million or 5 million because he has seen someone else valuing their business at $1 billion. Yeah? It also shows aspiration. That's what we aspire to. But sometimes our aspirations, we force them to come too early. Right? Then there's what we call debt. We are very familiar with debt. Simple. Which is, I think, the instrument Perez used. I lend you money, you pay me back with interest. That is as simple as it is. No shares, no nothing. You are not involved in the business. Right? And then now between debt, there are more instruments that are coming up that mix so many things. But the common one that we are seeing is revenue share. As it sounds, someone gives you money, and then they say, I'm going to take a percentage of your revenue until I recover my money with profits that we have agreed on. Is that clear? It's a revenue share. I give you money, you give me a percentage of your share of your revenue. It means I don't want to know about your profit and costs. If you have sold, like we saw last week, that top thing, the top line that we were getting when we were coming from the market, someone will come and say, okay, you got 40 shillings. I want my share. Before they even think about what? The costs. That is revenue share. People are developing that as an alternative to equity. Right? Because when you're early, some people don't want to borrow. Right? But then when you talk about shares, it has complications, like we'll see. So they are like, okay, maybe we do revenue share. It gives me some flexibility, because if I don't sell, then I also don't what? Don't pay you. That can also be profit share, meaning we look at the bottom line, right? Profit share. How much profit? That money we were retaining at the end is what this person who is interested in. Then we have grants, the very popular grants. Very popular now in the ecosystem. And we talked about this last week. It is a very good instrument with very good intentions that is very misused. We all know grants because we also get them, right? I give you money, you tell me what you're going to do with it. That is it. Maybe some impact. That is what? That is it. If you succeed, well and good. If you don't, we part ways. Now, these grants are liked a lot by entrepreneurs because, again, there is no obligation. The only obligation is activity. Nobody is going to hold you accountable to results, business results or commercial results. But what it does is that it creates a mindset of a non-profit. You basically create, if this is a CEO of a company, instead of creating a CEO of a business, you create a CEO of a what? An NGO. And this is someone who is always going to look for grants. Now, looking for grants means you have less time for the business. But you also lose the competence, what we call acumen, business acumen, right? The business mind that is focused on growing the top line, like we were doing last week, and increasing the bottom line, meaning they are always, we call them stingy. Right? But that's what business is. If you're going to maximize your profits, you have to maximize revenue and minimize costs. But a grant by nature is actually telling you have to spend the money by all means. So you can't, you get it? Because when they give you a grant, you can't say, I retained some, now, it's profit. They will tell you, bring it back. Isn't that what they say? They're like, bring it back. In fact, and you can't blame them, because the law in the US, in these markets where the grants are coming from, the law is structured such that if you're wealthy, you have to give a percentage of your money every year. And when you give that money, you get a tax deduction. Right? In fact, there is no way around it. You have to give that money. So if you have a foundation, in the US, I think it's 5%. You have to give 5% of your assets every year to charitable activities in form of grants. So these foundations actually also have pressure to what? To give the money. And that's why they don't like it when they give you money and you don't spend. So that instrument by nature, when you take it, you have to be very careful with it. Because there is a way it allows you, because now you'll be forced to hire people you don't really need for the long term, right? Because you have to spend the money. You said you'll hire. Right? You'll be forced to take trips and pay per diem. You spoil your team. When the grant is gone, you won't retain those people. You won't. And that is why, again, when you're giving grants or when you're encouraging people to take grants, you also have to caution them. Otherwise, it is what we are doing, which is to create NGO businesses. We call them businesses, startups, but in fact, they are what? NGOs. And that is why we are killing the ecosystem. And that's why those businesses, then the grant becomes so good that they start pitching everywhere. You've seen entrepreneurs you find everywhere. You got this competition, there is 5,000, they are there. Another one over 100,000, they are there. You get it? For the same things. That is the reason. Because they get comfortable. And I can assure you, if you show me a business that has been primarily grant funded, and has grown, I'll give you money. I'll give you my salary. Show me one business where they are mostly funded by grants. If you look at their cap table, more grants than any other form of capital, and their top line is strong or has actually been growing, I'll give you my salary for a month. It's not a bad one. And I'm happy to talk about it. I can assure you, I've been in the ecosystem now nearly 11 years. I cannot point to such a business. I can't. And that's why, usually when I see that, for me, I run away. I will caution the entrepreneur and run away. Because I know for sure that person does not have the mind of a businessman that is going to push this business. Because business is hard. It doesn't want comfortable people. Right? Any questions on this slide? Because we'll refer to it a bit as well. These are just foundational slides. All right. Yes?
Why exactly it cannot help you to grow the bottom line? Just the detail why it cannot.
Okay, why it is difficult? Because maybe it's possible and no one has proven that it is, right? I wouldn't want to say it is impossible. But like I said, the reason why it's difficult, a grant by nature, first of all, it means it's coming for a very specific purpose. Very specific. And by nature, it wants impact. You have to report back and say, we used this grant for this, and this was the impact within this month. That is one. Secondly, there is no grant that has no time limit. The grant always comes and says you have to spend this money within this amount of time. That is the nature of a grant, right? You have to spend this money within this amount of what? Of time. So if you look at those limitations, they are going to force you to do things, right, that are not smart in the business world. You get it? For example, and again, these are not necessarily bad things, but if you're working with smallholder farmers, right, training may not have an immediate return to you as a business. Training farmers, right? In fact, if you had a choice, you would outsource it and say, someone else do it. Me, my focus is I want them to give me the output, whether it's maize or whatever. I'll go mill it and I know where my customers are. But a grant will tell you you have to what? This money is for training. Then you look at the money, it is so good, you don't want to give it away. You are like, I'll do the trainings myself. Then the attention of your team goes from selling to training. So you end up creating a training entity. You get? So that's why you have to be careful with grant. Now, there is a smarter instrument that tries to come in between. And I've used it before. I actually encourage someone to do it. It's called a recoverable grant. Yeah? Recoverable grant. Again, these things as they sound is the meaning. A recoverable grant means I've given you money. Right? It's a grant. Meaning, I don't want shares yet. And you only pay me back that money if you succeed. Then you define what success is. You get it? If you don't succeed, don't pay me. But if you succeed, pay me. And success usually is you have the money in the account. Usually they will define the cash flows. If you have this amount of money in the bank, you pay me. That is smarter because it gives the flexibility that a grant would give, but it forces you, it puts some discipline, because you know this money has to be paid back. It's not the best, but it's better than a what? Than a grant. So if you're working with a development partner to design a program that has a grant, you'd rather advise that they structure it like that than a pure what? Pure grant. Because they'll still get their tax deduction. Because it is too risky, they can't keep it on their balance sheet. So for them, it will be a grant. But they have the opportunity to what? To recover it if you succeed. In fact, the incentive usually is that if you succeed, we'll give you more. So at least the entrepreneur. And what is defined as success is usually commercial. It's now not trained farmers, trained what it is. Training farmers is good. But it has to give you strategic advantage in the business. Strategic advantage in the business. Right? And the test usually is, if this was my money, would I invest it there? That should always be the test. Would I put it there? Right? Any questions on that? Now, one of the reasons we struggle as hubs is because we focus a lot on understanding businesses, but less on understanding investors in terms of how they operate and how they are structured. And that's why we struggle to help businesses or to give them the right advice. A fund is a business. It's not a charity. And funds, like other businesses, raise money from elsewhere also. Where they raise money is what we call LPs, or limited partners, if you've heard the word. These are also people, individuals or development banks, or that give money to these funds with an expectation of a what? A return. Then these funds tell them, we are going to go find good businesses that are like this. We'll give them money, and then they will succeed and pay us back. Then we shall pay you. That is the structure of a fund, what we call VC funds. Right? So it is very important to understand that this fund that I'm approaching to sell this business to is actually also a business and expects a return. The question is, which kind of return? You have to understand which kind of return they expect. That's question one. Yeah? We have to understand that. They are getting money. They have created a vehicle called a fund. They have gotten money from some people. Right? And those people are being promised a return. Then they come, invest. They are looking for businesses to invest in that can give them the return they promised. So this is not free money. They are expecting a return. Secondly, most funds, the traditional structure of a fund, as we adopted it from the US, is that the fund has a limited life. It's not like Maganjo or NSSF or these businesses that have a limitless what? Life. That life is usually 10 years. Meaning, from the day the fund starts, it is designed to close in what? 10 years. Sometimes they say +1, +2, meaning they have the opportunity to extend by 2 years. So the maximum life they have is 12 years. Within 12 years, they must invest the money, they must recover it, and pay back their what? Their investors. 12 years is 2 terms here, right? It could be 1 term. We get that, right? Now, if you have 12 years, usually they have a window of 5 years to invest the money. 5 years. So I want you to think of a fund that is 100 million, because usually actually the ideal funds, you think of SoftBank, billions, right? Billions of dollars. If you think of now the funds here, they are usually 10 million all the way to $100 million. Yeah? Funds here. Who has an example of a fund? Finca Ventures. Who? Yeah? Yeah. Although we are not this structure, but I'll talk about that. Finca Ventures, which other fund that is operating here? XSML, the Yield Fund, which other one? UNEA? Yield Fund, the popular one for agriculture. Yield Fund is I think 10 years. 5 years to invest that money. So if you have $100 million, you have 5 years. That is 20 million per year. You have to invest $20 million per year. So question, if you are the one, which kind of businesses will you look for? Your $100 million fund, you have to invest that money in 5 years. Let's discuss. You are now the investors. You have to invest the money in 5 years. What kind of businesses will you look for? Let's discuss. Just ideas. You are the investor. Let me display my papers. We are going to do strategy now. This is fund one. They are going to tell us their strategy. Fund two. People, just people your strategy. Here's a question before we start. Here's a question before we start. He's asking who decides whether it's 10 years or 12 years. So the owner of the money, who are the limited partners, right? Now, of course, this is a tradition that people picked up. Because this limited partner will not sit there and wait for an endless time, right? So this is a tradition that now people just know, even the limited partners, no, I cannot wait to receive my money endlessly. In any case, if I wait, there are risks, or there is a certain sort of, there is something that will happen. And that should inform your strategy. You get it? Your strategy should actually be aligned with the reasons these guys do 10 years and not more or less. Right? But primarily it's the LPs and the general partner. The general partner is me who starts the fund before I approach what? Others to join me. Right? Yeah, so I'll design it around there. Again, the current design is people just copy and paste. And that's why I'll talk about it. There are new forms, new structures that are coming up. Right? But for now, I have decided. You're a 10-year fund. You have 5 years to invest the money. What is your strategy to deploy this money? Which kind of businesses? I want you to think about the growth path of this business in terms of is it a high growth business? Is it a slow growth business, right? One. Think about the size of investments you want to make, right? Now we are on criteria, right? The criteria becomes your strategy. So you're looking at the growth path that these businesses are likely to take, the size of investments you're going to make, right? The stage that these businesses will be at, and the likely sectors that you're going to target. Those are 4 things. Let's just think about those 4. What is the nature of these businesses in terms of their potential growth? Right? How much are they looking for, or how much am I going to invest? In which sectors are they likely to be? What was the 4th one? Where? Stage, yes, and the stage. Yeah. So quickly, just 5 minutes. That will answer so many things. 1 minute, 2 minutes. Okay, 2 minutes. All right. We can start sharing. If you haven't finished, don't mind. Need to catch time. Let's listen and just we'll learn from the other groups. Shall we? William's group is still discussing. All right. Shall we start here? Fund one. Yeah. Manufacturing businesses. Food and beverages, etc. Yeah? Yeah? Household enterprises, what do you mean? Household items. Yeah? Oh, manufacturing, household items. Okay. Manufacturers of household items or like nice house? Okay. Uh-huh. Stage. Scaling. Another branch. New products. Okay.
Then market, sorry, size of investment,
Mm-hmm.
$1 million.
One.
Based in three.
Installments.
Yes.
But the target is 1 million per business.
Yes. And it's based on key metrics.
Mm-hmm. To receive another. Yeah, that's okay. What was the fourth?
And growth path is yeah,
So meeting demand.
yes, demand of
How big is the market? Uganda. Okay, so scalable, right? Let's look at their criteria and critique it or examine it. They are targeting manufacturing businesses, right? Food and beverages, household items like nice house or plastics. They are looking at businesses that are scaling, meaning they are growing another branch or introducing new products, right? And they're investing $1 million per business. So how many businesses do they need to invest in? 100, which is yeah.
can be 50, can be 50.
Okay. But what is your average target per business? No, per 1 million. So on average, it is 100 businesses, right? That's your strategy. And they are saying they must be scalable. What could go wrong with this strategy? What do we think could go wrong with that strategy? You're investing in manufacturing and you're investing $1 million per business. So think, yeah. Left hand.
Our country, if those get very few businesses.
They're saying they will get very few businesses in our country, right? Because you are looking for 20 manufacturing businesses every year to give $1 million, right? Statistically, if a fund is able to do 5 investments in a year, they are excellent. They are doing a good job. Because the effort required to do a 20K investment sometimes is the same as $1 million. Right? And I'm sure you have experienced through our Innovate and other programs that due diligence doesn't take a few weeks. How long is it taking on average? By experience, we are hubs. How long? A month. So it means even if you stretched and the businesses were there, okay, with maybe a big team, let's say you can do what? 6 or 12, even if you say 12, right? Because even if you have a big team, you have an IC, you have to find time for them to meet, isn't it? So 20 become a what? A stretch. And I don't know how, because usually PAL announces their investments. I don't know how many they are doing per year, but I doubt there are 5 investments per year. If there are 5, they are not exceeding 5. Right? So you can see that as a fund of $100 million, if you're 10 million, maybe it makes sense. But if you're $100 million, you're going to be pushed to look for businesses that can take more what? More money. Are you seeing that? So you're going to look for businesses that are pitching you 5 million and that is why one of the reasons expatriate businesses are raising money, because they're able to convince, right? They're able to convince funds that they can take in more, which is why they bulge their budgets, of course. You'll find a startup founder is paying themselves quite a good amount of money, right? Because they are coming from their ex-JP Morgan. They were earning 10 or 15K. When they come here, they want to earn at least half, right? So they are forced to also raise a lot of what? Money. You're seeing this strategy and why it goes wrong. So it means when you're looking for a fund to recommend a business, you have to understand this dynamic and how they are going to actually view your business. Now, they may need 1 million for the start, but is there any chance that they will need more over time? Such that at least when I add up what I put in together, it comes to much more money. Because otherwise, there is no way I'm going to invest what? 100 million. And in the fund world, if you fail to invest, it's failure. The next fund will be harder for you to raise. So it means they are forced to look for bigger businesses to give this money. Right? Okay, we'll come back to that strategy because of time. Fund 2. Quickly, your strategy. Fund 2 is this one. We are going like this.
Our strategy is going to be to diversify
Diversify. What does that mean?
following sectors.
Mhm.
I don't know if sectors, but okay.
Sectors.
Education,
Education.
agro-processing,
Agro-processing.
reporting
Yeah.
in the creative sector,
Creative
export,
and export. We can. Yeah. So there's a bit of similarity, right? We can. And logistics. Okay.
So we are looking at that have a medium pace of growing.
Medium pace.
Yeah, yes.
Call those
Fast, but also not very
dynamic growth, right?
dynamic kind of growth.
Dynamic means growing steadily, but growing, right? Steadily. Like just the especially man, and you can see that aligns with the kind of businesses they are choosing, right?
When we are looking at a business should at least can, let's give an example of agro-processing Mandela. It can take 5 million and it has what we do this.
So you're saying 5 million. I hope you didn't amend your strategy. Please don't amend. We need to
You can see
we need to learn from your strategies.
across a single thing.
David, don't discuss. It's okay. There is no right or wrong here. Yeah, it's not an exam.
So that is it again.
There was the first. Okay. Yeah, dynamic stage. At what stage?
At what stage? Scaling.
Scaling.
They have to be at scalable.
So for 5 million,
Let me throw the pen away so that
for 5 million, they need 20 businesses, right? To invest $100 million, which becomes how many per year? About 4, right? Which is manageable. Yeah? It's manageable. What could go wrong with this strategy? Yeah? To finish the money. Exactly.
we have examples for everything that we said here.
So let's listen. He's saying it may be difficult for them to find this kind of what? Businesses in Uganda. Because even the names she's mentioning may not need money now. They may have the money and they don't want to give what? Shares. Isn't it? Or even if you're doing that, they don't want. So it may not be easy to find these businesses. What could they have done? What else could they have done? What could they have done? Because they are looking at Uganda, right? Geographically. What can they do to improve their strategy? Expand the geography. They can expand what? The geography. It's like that instead of Uganda, they are looking at the entire what? East Africa. Yeah, or Sub-Saharan Africa. So you get eh? So that's what they could do to still achieve what they are looking for. Because the main weakness of this strategy for Uganda is the type of what? Businesses. Okay? Quickly, Fund 3. Uh-huh. Energy. Agrobusiness. Microfinance. Scaling. Mm-hmm. How much are you investing? You hadn't go. $10 million per business, eh? That is for energy. Mm-hmm. 20, eh? Uh-huh. 20. And you seem like you're looking at dynamic businesses. Again, what could go wrong here? The money, right?
Looks like they want to invest on their own. Like go to the
Because it's not very practical in this market, right? Because 20 million will be a bank, and the bank will most likely not be easy to get. Yeah? Because what you're calling microfinances, their capitalization, most of them, is way below $20 million. They can't. Yeah, it is possible, but it's still difficult to find. And usually because there are details, right? If you're giving them equity, they won't take because you're going to take the entire business. That's one, right? If it is debt, you may not want to give them the debt because, again, it is too much. They may not be able to what? To pay. So you see the dilemma that these funds are always struggling with, right? And that is why, in some cases, when you're a good business, we have actually been in a boardroom where they brought a business that was looking for a certain amount, and then someone on the meeting asked them, can they take some more? You get? The resolution was encourage them to take what? More. Because this was a business that was showing some signs of good performance. So there are cases when you're what? You're actually incentivized to take more money. You get? And that's why the more bigger funds we get, the more sort of, the easier it becomes for certain types of businesses to raise money, but the more failures you get. You know why? Because there are businesses that are going to be forced to take money too early before they figure out things. And that's why a business that has raised 200 million, 100 million collapses. Because they were forced to take the money before they figured out things. But you can understand why the funds are also struggling. Because they also get money from elsewhere. And there is pressure to what? To invest. Just like the grant people. All right. Quickly, maybe we'll pick. Is there one that had something very different? Because there is something I'm missing, actually, that I expected. Yeah? That group? Just to save time. Sorry, just a minute. Uh-huh. Agritech. Agritech. B2B. Profitable in more than one country. Multi-country. 2 businesses per year. How much are you investing? 10 million. Okay. You're committing 10 million. Yeah, including follow-on. So you need 10 businesses for the entire 10 million. Again, the difference here is that they are doing now technology. We haven't seen technology in the previous funds, right? So by nature, if you're doing technology, the growth path should be high growth. Yeah? High growth, meaning you should be able to grow. When someone talks of technology, in most cases, it's rapid growth. Is what is expected. Right? and they are saying 10 million. Where do you see challenges here? Agritech, yeah.
First, they're investing little money, yet they have a lot of money.
They are investing,
The money?
but they are investing 10 million per business.
No. Per year.
2 businesses per year. So that will be 20 million per year, which is after over 5 years, the money will be done. Have you seen?
Yes.
10 million per business, they are committing in 5 years. So it means each business must be able to use the money within the 5 years. Yeah? What could go wrong? Yeah.
Technology might fail.
Technology might fail, it's high risk, right? What else? Actually, I wanted to talk about this. If you look at 5 years, it also depends when the business comes. If they come when you are in year 3, will you still be able to give them 10 million? They have 2 years to use the 10 million. Will you still be able to give them this money? Will you be able to deploy this money? So your 2 per year may be too low. You have to utilize your first years and get like 3 or 4. Or get all the 5 and assume that at least you have them. Now it's about when they take the additional money. Are you getting? Yeah. Now, for those that didn't share, you're going to share in the next round. After 5 years, you have to recover the money in the next 5 years. Don't change your strategy. Assume you implemented your strategy. Now you have 5 years to recover what? Because we say the fund is 10 years. You spent 5 years to invest the money. Now you have 5 years to recover the money. I want you to go back to your strategy and think about what you would have done differently if you had this in mind when you were designing. You get it? Because I didn't emphasize it for a reason. You had 5 years to invest the money, but you also have 5 years to recover that money. That's what we call exit. 5 years to recover the money with a return. What would you have done differently? So the groups that didn't share will share 3 minutes. What would you have done differently if you had this on top of your mind? That yes, I'm investing, but I have 5 years to recover. Yes? Yeah. Yeah. Let's listen. Let's learn from each other. Someone is, excuse me? Let's listen to him. Uh-huh.
So 70% of the fund will go to very high growth established businesses,
High growth established.
which we can use to guarantee
Yeah.
certain level of return.
Mm-hmm.
When business models are established, they are good.
Yeah.
So that's 100 million, that's about 70 million total.
Yeah.
Of those businesses, targeting about 5 businesses.
Yeah.
Also, over the entire period,
You're investing how much per business?
about
14,
14
eh?
million per business.
Yeah.
Not all at once in a year.
Yeah.
Maybe 14 in the first year, giving them about 1 to 2 years. So maybe splitting that into 2 tranches.
Mm. Yeah.
So say if at all each tranche is maybe, okay, let's do every 2 years we're investing. So we will take maybe about 3 million.
Yeah.
And the business giving you time to pay back.
Mm-hmm.
And then after that, we reinvest in the business in our 3 million. So structuring it that way.
Yeah.
For those businesses. Then the remaining 20%, 20 million, we could then invest in other businesses, maybe medium or
Medium sized.
medium, maybe those seed investments,
Mm-hmm.
which can take on up to about 1 million,
Mm.
also in a similar kind of structure.
Mm-hmm.
Instead of having it all at once, phasing it in maybe 2 years.
Yeah.
That way we have time to assess how the returns are coming in.
Mm-hmm.
If at all need be restructured, the fund media.
What instrument are you using? Debt, what type?
So for the higher stage, I would think maybe debt,
That.
or if you keep retaining again,
Mm.
maybe a convertible,
Okay.
which is aggressive, but largely debt, because you can then see are they paying back,
Yeah.
and then you invest.
Mm-hmm.
For the smaller ones, it could kind of be, again, also lendable, right?
Yeah.
Convertible maybe debt that turns into equity, but certain conditions.
Yeah.
Then for sectors, we're looking at, because of the landscape that we're in, businesses that are largely in agro-processing tend to bring in more cash flow.
Yeah.
That value addition aspect.
Mm.
And then also tech-related businesses, or maybe the medium size,
Tech.
they have high growth potential at this time.
Yeah.
That's how we're
Yeah. So you can see what makes sense is that if you are investing in high growth or established businesses, the debt is possible, right? And the debt by nature is self-liquidating. So you can still structure the instrument to make sure by the 10th year you are fully exited. Isn't it? The problem is usually with equity, right? Because the only way to exit equity is if your shares are sold or bought by someone. That's what they call an exit in equity. You essentially, because you bought shares, right? Now, the only way to exit is if you sell or someone buys. The question is, in this market, how easy is it? Right? It's not easy. Because you have to find someone who will buy the business, right? And they have to buy it at a value that actually gives you a return. So it's not that you're just selling, no. It must be at a certain value. And that's why a fund like this that is actually targeting a tech businesses, right, in the early stages, is only going to invest in businesses that they strongly believe are going to grow rapidly, not just rapid, but very rapidly within the 5 years. Because if this business, when I invest, if it is valued at $1 million, if I have to get a return, then their value must grow 10x, beyond 10 to 10x plus. Because that's when my investment will make what? Will make sense. Now, equity is also even more challenging because in most cases you lose more than half of the investments you make. That is the statistic. In fact, you may lose 80%. So you're actually relying on 20% to get back your money with a return. So invest in business 1 to 5 with hope that 2 will give you a return to recover their money and the one you have lost in others. Does that make sense? So it means within one business, if it is to grow and pay you back, it has to grow more than 10 what? X. That is why 90% of this capital we are celebrating that is coming into the region is going to take businesses. And expatriate-led tech businesses that are led by men, because those are the bold people that can stand in front of an investor and tell a lie or share hope. You get it? You have to your confidence level has to be at that level. You have to sell this potential. But naturally, of course, because of the limitations, we know the reality so much. You get it? We know so much of the reality that it is hard for us. Because the other person, maybe they're actually innocent. They don't know the realities. I'm just saying maybe. You get it? Yeah. When someone is building a logistical business that is going to do delivery, maybe they don't actually understand that people here don't have address.
They don't know.
Because in the US, when it's plot 18, it is plot 18. The map will take you. They forget that here.
We don't know what that is.
You get it? Secondly, when they hear everyone has a mobile phone, maybe they actually believe that a farmer can go easily,
And the tap on the app.
can go and tap on the app and say, bring me fertilizer. They say, maybe it is easy, right? And I'm sure that's why Easy Agric is B2B. Maybe he can talk about his experience, but that's why B2C is hard in this market. Because yes, the statistics support this business model. In fact, for me, for e-commerce, I only do B2B. B2C, I have to be very cautious because it is very difficult, right? So, and these are realities that are important to know. It's like that you know what you're selling, right? So these entrepreneurs, ex entrepreneurs, right, or expatriate entrepreneurs, will sell a story of 15 mobile phone users. There are 15 million mobile phone users in Uganda. So if you're selling anything that requires a mobile phone, it makes it feel feasible that you can get, even if you got half of the 15 million, right? You see those pitch decks. They actually say, I only need 10%. Only 1.5 million Ugandans. Then you do the math. You are like, if I get $1 per, that is 1.5 million. Huh? Just $1 per transaction from each of the 1.5 million is 1.5 what? $million per month. Times 12, $20 million. Right? Then you are like, how fast will you achieve that? Very fast. Right? Now it's possible. The question is, it means you have to internalize the value proposition a bit more, because mobile money has done it, isn't it? Yeah, mobile money has done it, and it's possible. But it is not easy. And in fact, the reason why funds actually write to build their statistic on 20% success rate is because that's actually the nature. You have one mobile money. You get it? You have one hit out of 10. So you have, when businesses approach you, you need to think about these things, because it helps you know which investor to approach, right? It helps you know how to advise this business. Say, okay, if you're a tech business, you must be very good at pitching and selling. Very good, because there is no way around it. You have to sell a big story, right? So if you're looking for 500K, 100K, year on year, people start to run away, right? Because they don't see you're going to be a burden to them, basically. You are looking for 30K, 50K, and you take business, it doesn't make sense. If it is tech, you have to behave like a tech business. Go big. You get it? Yeah, go big. Now, it doesn't mean, of course, you can't take money you can't take 100K or 200K. But what we call rounds, the size, and the potential, again, it's also about the potential. If you take 1 million today, how soon will you need more? This is the traditional model, right? The good news is it is what? Being challenged. That model is being what? Being challenged. Because the question the investors are asking themselves is, we took this model from the US, from developed markets, we brought it. It's been many years. What are the success rates? Yeah? What are the when did you last hear of an exit? A business has been bought by another business. When did you last hear of one? In Uganda. How many years ago? Warid Airtel? Orient Bank. You see, there are not things that happen every day. The other question is, when did we last get an IPO? Because that is the other way to exit, isn't it? Yeah. When a startup that has grown goes public, so us that invested early can now sell our shares to the public. When did we last get an IPO? It was Umeme, isn't it? MTN actually recently. But before MTN, how many years between Umeme and MTN? Very many years, right? So those are the realities that are coming down to the funds. The realities, yeah. Yes. As if I don't have what? What I know is that Deloitte has closed the advisory firm. I'm here, moved it to Kenya because there are no deals. There is a, yeah? Here, they do it from Nairobi. You get? I'm forgetting the name. They actually have M&A advisory, and their staff are idle. So if you ask me whether I'm advising on exits, the truth is no. I'm not. And the fact is, it's not happening. Even MTN didn't exit. People, I mean, it was a fraud. That's your opinion. But I'm sure the shareholders, some sold, right? So exits, even me, I don't have any, sorry. I'm not seeing any. I don't have what? Any. And that's why I don't even have data about it, because it's not there. Right? Those that will happen, of course you hear some, like recently in Kenya there was one, but this is a business that actually was going to close. Yeah, yeah. You get it? So even what they call exit, of course we never disclose price, but sometimes you find that price is in the negatives. Exactly, it's in the negatives. That's why they don't disclose, so you never know. But there are some transactions I see and I'm like, There's one that happened here, I can't say, but there's a startup here that published. That's the question. Why aren't we seeing exits?
I think this might be a bit naive, but we still have, because I was talking with my neighbor, and there's this fear of, even when we are doing the high innovator, there's this fear of what? They want 1%? So there's that, the businesses are just like a child, so people are still in that place where we're not yet scaled to think about that.
Yeah, so of course, naturally, businesses that start here, again, what I call dynamic or legacy or family businesses, right? People want to own them forever. So you will not find people actually offering, because that transaction usually has to have the buy side and the sell side. So you may have buyers, but no sellers, because that's the nature of businesses, right? Nice House of Plastics wants to be a family legacy business, and many others. So that is on the sell. There is no supply of deals. On the buy side, we don't have so many conglomerates that are here, right? That still have room to expand further. They are either already dominating, right? And they don't, because usually you buy another business because you want to expand easily without you having to start afresh, right? You buy. Or you buy because they have a competence you don't have, strategic competence that will add more value to your business, right? So you buy. So we don't have the buy side, neither do we have the sell side. And that is the stage of the economy, of the African economy. We are still growing. We are creating the foundation that was created in those markets so many years ago. If you read the documentary, The Men Who Built America, the kind of businesses that started then were the kind of businesses we are starting now. Steel, plastic, railway, those businesses just create the foundation on which the tech businesses thrive. You get it? That's why you cannot say, I have an app where people order and I deliver and there is no logistics infrastructure.
So we are 200 years behind.
You get? So there are just so many dynamics, which I'm going to take the last one because we.
Yeah, like the Berkshire Hathaway.
Who has an answer for that?
Because they are conglomerate.
Yes. Doesn't make sense. So they. Let's listen. Let's listen to him. So, like he said, right? What does Amazon sell? It's like Jumia or books. How big is our middle class? Because those would be their customers. Statistically, I think there are 800,000 taxpayers in Kampala. That you get, 800,000. That is what our middle class is. So Amazon can't come for 800,000 people. But also the consumption behavior of our 800,000. You heard that we have over 1 million bank accounts, but so very less that have any balance. Huh? Any balance. Now, how will Amazon make money? And the infrastructure, right? The infrastructure is also weak. Because their value proposition is quick delivery, those things, which are naturally difficult here. All right. I think our time is running. So, from where I sit, I used to run a survey of investors just to sort of understand what deals they are making, why, how they are making decisions. And from that survey, these are the 4 things. 4 reasons, at least from what investors say, the main reasons they say no to investments. The main reason they say no, every no they say, is likely because of these 4 things. So others said insufficient evidence or product market fit, meaning businesses approach them when they have zero evidence that what they are offering is indeed needed by the market. Right? So we have so many pitch deck entrepreneurs, no research, no experience, but they are looking for money. So investors often say what? No. The second reason they say no is unit economics that don't what? Work. Loss negative unit economics. We looked at that last week. I hope you still recall. If your margins are still negative, you get it? You haven't yet showed that you can make money. Second. The third one, which is what we just talked about, the market isn't big enough to make the kind of return they need, which is why Amazon wouldn't come here. And so if you're building an Amazon here, even the investors may question the size of the market, right? And then lastly, I don't trust the team. This is actually the most common one. The last one is the number one reason. I don't trust what? The team. And this is why, of course, when people say there are some cultural biases in the investment world, it is possible. Because even if you traveled to US and you found a Ugandan, you're happier with them, right? Because you can talk. There's a time I went to Guangzhou on the street, you hear Uganda everywhere. Everywhere, you feel even more comfortable, right? This side Uganda, the other side Uganda, you get it? So even them, because the real fact, and this is why we need to understand this, because we won't change it soon. The fact is, most investors are foreign. That's fact number one. Secondly, it is a fact that you as a Ugandan have a higher burden of proof, right, than a non-Ugandan. You have a higher burden to prove yourself. And that's the fact. It's culture, sometimes it's subconscious. Like even you, when you go to the US and you are investing, Then you find a Ugandan, first of all, it's easier for you to understand if they are lying or not, right? It is easier for you to know their mannerism, to know if to trust them or not, right? Because you understand the culture. So rather than blaming and saying, oh, cultural bias, we have to work around that, right? So team, you have to find a way to earn the trust of someone. Somehow, I find that I've not found in my expatriate community, I rarely find people that don't drink beer or some kind of drink. So usually when people ask me whether they want to go out for beer, I don't. But I'll say, oh, fine, yes, let's go. And the reason I do that is because if I already start and say I don't take beer, already I'm creating that gap, distance. But by saying, oh, that's fine, you get it? I'm trying to relate with them. And that's why fundraising is about relationship building. And so if you're supporting businesses, you have to support them on building strong relationships. The stronger the relationship is, the easier it is to talk and convince an investor. There's a time, and that's why you guys have to do even a bigger role in terms of building your network. Because sometimes an investor will trust an entrepreneur because of you. You get it? When you refer and say, we've worked with this business, I think you should look at them. And that's why businesses attend accelerators. Do not be lied that these businesses are looking for very good advice. They are looking for, skills. They say that, of course. But the truth is they are coming because they think by coming to Outbox, it is easier for them to raise what? Money. Like we said last week, that's the realities of business here. You need money and it is difficult to get what? Money. So coming to UCU or Outbox or Tech Buzz or even Shona, they are coming, of course, they will learn, that is the truth. And they may actually want to learn certain things. But on top of that, they want money. And usually that motivation overrides everything else. William is the entrepreneur here, I will tell you that. Yeah? That's why there is some fatigue in the ecosystem now. There is fatigue, there is too much training and less money. So we have to be honest with ourselves as hubs. We have to understand that there is what? Fatigue. Because if an entrepreneur is going from this hub to the next hub, no money, then they start saying, the actual entrepreneurs, you don't tell anything about programs. Because of that. So we need to really play a role there. Like I said, have some money. But when you have that money, then build a strong network. Have some investors that are really your friends as a hub. And that is a fact. The moment you know that, you'll sort of start to do things differently. There is a time I went for a meeting with an entrepreneur, and in that very meeting, the entrepreneur was offered 50K. So when I left, I was trying to analyze, understand why, like what did they do different? One meeting like this, he got 50K. The reason is, I understood that 50K, first of all, was a very small amount for this investor based on what this is an individual, high net worth individual. Very small amount, but also secondly, it was just a case of trust and how I did the intro. And thirdly, I went with the entrepreneur to that meeting. So I supported the entrepreneur during what? Because sometimes it is about translation. There are actually so many meetings where I see the entrepreneur is pitching, and then the way they are pitching, language, because English is not our first language, right? So sometimes you say something that the investor doesn't understand. You talk of farmers, you're talking of, villages. There are things you use to describe these farmers that an investor has never seen. You get? So then it becomes your role to because you understand the investor. You know maybe a bit of their history, you built the relationship, right? The investors I know they are from wealthy background. I know they exited the business, so they have been wealthy throughout their life. They are most likely never been to a small what? To a village or to a farm. So if you have a business and they are pitching, then it becomes your role to help translate those things, right? So relationship is very important because again, trust, this is how you overcome the culture things, because like I said, that is just going around them, right? Let the funds or people who are raising money start local funds, locally led funds. If you want to start a fund also, that is good, right? As a local fund manager, that would be good. But before you do that, you have to go around the culture biases. So those are very important things. So if you solve those, you have a higher chance of raising money for your businesses. Now in summary, I want to talk about these circles in a bit more detail because they relate to the last bullet points. We talked about team, right? And the question is, what makes a strong team? We talked about team as a very important thing, and one of the reasons investors will say no, they don't trust the team. But what makes a good team? William, you said you made an investment. How did you assess the team? Equity. Yours was an equity investment. Business acumen. How they understood the details of the business, right? Track record. It was profitable. Eh? Mm-hmm. Mm-hmm. So he could articulate it. Mm. So he had a growth mindset. Yeah, exactly, right? Friend. So it was easy to build the trust, right? But he mentioned something very important here called business acumen. Even when you Google, you never find a straightforward answer of what business acumen means. But then he mentioned unit economics. I've narrowed down business acumen to understanding your numbers and the drivers of success. What are the most important things in your business? And you understand the numbers. If you don't understand the numbers, you can't convince me that you have business acumen. Experience is very important, but for me, experience is if you're building tech business, agri-tech, what experience do you have in agriculture? Yeah? Have you studied agriculture? Have you lived in an agricultural community for most of your life? Were your parents farmers? You get it? That's what I mean by experience. So if I'm investing in a fintech and the person who is running it is an ex-banker or, was working in the financial services, of course that's a stronger team. It attracts investors more. Yeah? So business acumen, traction, experience, and lastly, trust, because they were friends. Now, trust is sometimes it's subtle, it's subjective, and you can't do away with that. And that's why it is important. I always tell entrepreneurs, be nice. I don't know, whatever that means, be what? Just make sure that person likes you, and that is it. That's why expatriates raise the money. It is they know their people. You get it? So you also have to be nice. Find a way. Yeah? That is subjective. I have no alternative there. It is as subjective as it sounds. Yeah? Sorry, please. Yeah, louder. Mhm. Credibility. Yeah. Yeah, credibility. Credibility is, there are now so many lies in the market. In fact, in due diligence, yes, be bold, but credibility, actually, to the extent that now when we are doing DD, we do a code search to see if you haven't involved in any what? Any fraud. These days, forged bank statements are like food every day if you're in that business. NASA. So credibility, make sure you show credibility, because that is a turn-off, of course. And investors know each other, right? So if they know each other, it's a small community. So you cannot survive for long without being credible. Now, so teach your entrepreneurs to really pitch their experiences. Let them pull their experience. Experience is not that you've worked. It could be, like I said, you've grown in a community where there are farmers. Your parents are farmers, right? You have to sell that experience because it helps, right? Scalability, we talked about that and we saw why that is important. And someone tell us why that is important? Why is scalability important? Why does the market have to be big enough for the business to actually grow at that kind of scale for it to be attractive? They have more money to give, so if you're not scalable, it means you're going to take less money, so you're not as attractive, yeah? They can get back the return. And usually they are relying on 2 or 3 businesses. So really scalability is important. So to assess scalability, they look at the problem, how big is it? The problem you're addressing, how innovative, because usually innovation, technology means scale, right? And then a competitive advantage. If you don't have much competitive advantage, you're less likely to scale because you're limited, the competitors, the market. Sorry. The market is already occupied by so many people. So you always have to assess scalability. And then governance. This is the mother of all problems for local entrepreneurs. Is that your experience? They don't want to be accountable to anyone. It's my business, isn't it? It's my business. And the reason usually they say it's my business has to do with financial things. They want to go withdraw the money as and when they what? Now, if that is what you're doing, will the investor get back their money? Like I said, when people get money, the first thing they do is buy a Subaru or a car, right? Because there is no governance. You do what you want with the money. So you're a risk to the investor without accountability. Because when they give you 1 million, you may spend it all on yourself. A house, a car and a house, those are the things. A plot of land. Yeah, in Garuga. So governance is very key. And it is with basic things like he talked of formalization, making sure your business is registered. Compliance is actually key. It's a big risk. And if you've been through a DD, you'll know that they will look at tax compliance. They will look at those things. Because if you're not compliant, anytime you can be closed. And when you're closed, that investor loses their money. So compliance is key. And then lastly, traction, which we've also talked about, right? Now, people always talk of business plan, and there are so many definitions of a business plan. So I want to talk about that. Of course, you must have a strong business plan, but what is that? Is it the traditional 100-page document? Who works with their businesses to build that kind of business plan? Or how are you, because you're working with businesses and you're working on business plan, what are you working on when you're working on a business plan? We can just share ideas here, because there are also so many opinions on this. Anybody wants to share what you're doing? You don't have to think about it.
Analysis of the competition and environment.
Competition and environment, yeah. Analysis, eh? Market penetration and financials. So for you, okay. Yeah. Market size and revenue model. So usually for investors, especially at the early stage, which is where you guys are focused, right? If you have a very good pitch deck, and I'm happy to share templates after this, I will share. But if you have a very good pitch deck, which again I'm sure we've all looked at, the elements in a pitch deck plus a financial model, right? A very good financial model are usually sufficient in most cases. For the last 10 years, I've not seen any investor asking for the traditional business plan. Yeah? Maybe the banks, but you know the banks ask for checklist.
Yeah, those checklists, they always have business plan.
Which they never read.
But you know, that's something.
And audited.
You have a business plan, then you're like,
They will say bring the other one. So that's when you get a consultant, then they will copy and paste checklist, right? Yes. Mm-hmm. Return on investment. Yeah. In most cases also, if you've done the pitch deck well and someone asks about some other things, it is easy to put them together, right? Caveat is if you've done it yourself. So never attempt to write pitch decks for an entrepreneur, because it's a pitch deck. They are going to use it to present. So if you write it for them, then there is also no ownership. Usually it's better to facilitate, right? You can have a session, take them through the elements, and have them go do it. Graphics someone can do, right? But the contents, make sure the contents are done by themselves. Because there are some lazy entrepreneurs. And usually when you pay, even financials, when you pay consultant, it is hard. There is an entrepreneur who reached an investor meeting. They ask questions until he admitted that the truth is, I am not the one who did that model. You get it? And that is Potea. After that, so you have to ensure that the entrepreneur is involved in the process, right? They must be, and that's why an entrepreneur, they always tell them there is no option. You have to know the financials. You can't be in business and you are like, those numbers, they are for this one, for the accountant. You can't. It's just not possible. You get it? And even us who are supporting them, you get it? We have to understand. That's why last week was very important. You have to understand where the value is coming from and the numbers, and that is very important. Because like I said, if someone is able to articulate their numbers very well, they know the story, they can tell the story of the business in those numbers, they are likely active. They are doing something. They know what they are doing. Of course, there are people that practice enough to know even when they are. Hey, you get it? There are those, but even those you can catch them if you yourself know. And usually when you're reading or preparing businesses, behave like an investor. Behave like an investor. Because then when they face the real investor, they are ready. You had something? Just one more? Yeah. You had something? Yeah. Yeah. You had a question?
Like it's here, I had a case today when someone came to me and said they're looking for an investor, and I asked them what kind of investor you're looking for, and they told me the business they are going to do, and interestingly, they told me how they are looking for an investor so they can buy about 5 motorcycles to help them do deliveries. And I already have a contact of someone who can give them the motorcycle. I told them, like, not money, but motorcycles. Get the motorcycle if it is what you want, not in kind. Like, turn the money you want. These are the motorcycles. This is my investment. So I asked them, so what do you have to show that this is the money you want? And if you have the motorcycles, will you be able now to go to the market? And then they started telling me, oh no, we shall also need fuel. And the app is in its final stages. So I looked at them and felt like, yes, they are looking for an investor, but they do not know exactly what they need, what kind of money they need right now, and what should do for them. Now, in a situation of that kind, how do you manage the expectation of an entrepreneur at that point, given you have clearly assessed that they don't need that money for the motorcycles, but rather they need another type of money or something? How do you handle them?
Yeah, so of course I would encourage honesty, which to be honest is also lacking in us as hubs. We overpromise. Yeah? The business comes to you, you know they are too early, and then you say, yeah, let's do pitch deck, you go through this program, right? We'll get you investors. And that's why there is also fatigue, right? Because that's what every accelerator is selling. Every program, right? We are all selling what? Raising money. And we are not honest about what it takes, right? So in that case, I think it is to have a honest conversation with what? With the entrepreneur. And tell them, you know what? The truth is, you ask them, first of all, ask them, right? Ask them the questions and note what they are saying. Yeah? Say it back to them. Say, okay, so you're saying you do not know, right? You're saying that this amount you actually wanted is actually not accurate. That tactic, by the way, repeating what someone is saying is very effective. I also use it when I'm selling. Because when someone says, I need this, and say, okay, you need this, right? It sinks. You are emphasizing. Yeah? Yeah, that is just something you can use. Saying back things to someone, the way they are saying it, is a very effective way of emphasizing things. So when someone is telling you like that, right? Telling you they need this money, and then you ask them a question, they are like, oh, we also need fuel. You are like, oh, so you hadn't budgeted for it. Does this mean this money is not enough, right? As you take note. At the end of the conversation, you go back to the same things. Like you see, first of all, the amount of money, it looks like the amount of money you're looking for is not enough, right? And it looks like you haven't thought through the entire process of what you need. My suggestion is you go back and think about these things, or we can have a meeting to go through your plan. And the reason is because when you go to investors, this is what will happen. Honest conversation. You have to stop promising, over promising, right? Any questions? Now, so of course beyond readiness, which is you've assessed, you know where the business is, you know what they have, what they don't have, and maybe you've created it. The only way you can create value is by having your own pipeline, right? You have to actively invest in an investor network. But the reasons businesses come to us is because their network is limited. So if you're a hub with no investor network, there is no way you should sell investor readiness or investor matchmaking, right? You can't tell people, I'm going to help you raise money, and you have no what? Network. You have to actively build that network. Like I said, you have to understand the investor and how they make decisions, which varies, right? Based on the things we talked about. Now, this is important because if you go back here, I want to go back to this slide. This slide here. Like I said, I think people are suddenly recognizing this is not working. So we have a new form of structure that they call Evergreen Fund, right? That is coming up. Evergreen means our life is not limited. We are like any other company. Our goal is to exist forever, right? Because the moment you remove the time pressure, the decisions you make change, right? The moment you remove the time pressure, the way we make decisions change. That is the only way we'll invest in manufacturing. Those that had the manufacturing strategy. Because manufacturing requires time. If you look at our success stories, they have been built over 20 years. 20 years and more, isn't it? Nice House, Jessa, which other ones? Mukwano. All of them over 20 years. So you can't put pressure on a manufacturing business to exit in 5 years. It's just not possible. Right? So if you have a manufacturing business, your best shot is to look for an evergreen fund or a fund that has no life limit, meaning it invests forever. It is always what? Investing. Secondly, the truth is equity is challenging when you're dealing with such businesses. It is what? Challenging. Because equity by nature requires you to exit. The traditional equity. And an exit requires either an IPO, a merger, which we said is also what? Difficult. So the other instruments, revenue share, debt, and profit share become real what? Options. Or the other third option is what we call redeemable equity. Meaning from day one, you agree with the entrepreneur that you have to buy me out. You get it? You have to buy me what? Out. Redeemable equity. So we have to increasingly look for those funds. Again, there are not many, and these are the limitations, right? But they are there, and they are starting. So do not promise a manufacturing business. Promise them based on the fact or on the hope that you will go to a VC fund that has 12 years for them to give you money. Right? Now, because these funds, of course, are not many yet, that's why High Innovator becomes important, right? It's the same reason we started a fund. We started a fund and we convinced someone else to start a fund that is structured like that. So, because if you look at if you look at the kind of businesses that are in the hubs now, they are increasingly less tech. Right? When the buzz started, it was all tech. But you are increasingly, if you think about High Innovator, you're seeing more manufacturing businesses. And the hubs are embracing them. But what is the alternative on the financing? We must play a role there. And our role is to influence investors, but also to start our own what? Where we can. So if you're designing a program of, say, $2 million, and you have zero money for investment, you're doing a disservice to the businesses and to the ecosystem. It's a big disservice. That's the fact. I'm here to tell you facts. Because I've spent a lot of time intentionally with entrepreneurs that I have sort of empathy. So even me, I run a program, but I have a lot of empathy for entrepreneurs. And these are the things we discuss even with my team every day. Right? Because these are the facts. And until you're in their shoes, you won't appreciate them. So start a program, try as much as possible. Have some money, right? At least to give them some traction. Because the money you give, the role it plays is to give them traction. It's like that when someone leaves the program having known that, oh, my customer profiling is not yet accurate. I do not know who my customers are. Or I need to get a bit more customers, but then I need some inventory. And in some cases, it's not a lot of money, especially when you're talking about manufacturing, right? Of course, tech is different. If you give 5K to William, he will chase you away. But 5K to a small manufacturing business makes a big what? Difference, right? But then again, like I said, more of these funds are coming up. More of these funds are what? Are coming up. So we either start the funds or influence the investors to what? To change. If everyone is speaking the same language, if an investor comes to you, I'm looking for pipeline, you tell him, my friend, the truth is, I can maybe get you one tech entrepreneur, but most of the businesses are like this. And I don't think you'll invest with your structure. You need to consider, and it's possible, it takes time, but it is possible. The other fund I'm managing now is run by a family foundation that has been doing grants. It has taken years of convincing them, of telling them grants are not creating what? Value. It takes years, but they eventually get there. Now, it is a fund. Of course, they continue to give their grants, but they are now careful who they give a grant, who they give a loan. That's the other thing. They would have started equity, isn't it? They would have come because of the excitement in the ecosystem and started a fund to do what? Equity. But we told them the fact is, equity is not working well. Do concessional debt. Do debt and make it easier to access. Because after all, even when you do equity, you lose the money. You get it? So at least you look for entrepreneurs you can trust and give them debt without collateral. You get it? At least. Because either way, if you do equity, you lose the money. So why not do concessional or debt that is more flexible? So those are the roles we have to play. That the reality is these funds are starting, but they are still very few. And I think even Pearl Capital is now doing debt, right? Which is very good for agriculture. They are flexible, right? They do some debt and do. So I wanted to emphasize that. So when you're matchmaking, make sure you try. Actually, when you're meeting investors, these are the things you understand. Don't just have coffee and say, okay, which investors are you, which entrepreneurs do you want? How much are you investing? Okay, I'll send you some businesses. Then you send 20 and they reject all. Then they will never come to you. Then you'll have no opportunity to create investor relationships, because you are not adding value to them. When they come to you, you do the checklist very well. You understand them. You match them with the right businesses. You're creating value, right? And if businesses come to you with these wild expectations because they also do not understand how investors operate, then it becomes your job to guide them and be honest with them, right? Any questions there? So after that, of course, you do internal matchmaking, which is what I was talking about. Internally, first look at your businesses, look at your investors, make sure the matchmaking is making sense. Mm-hmm. Have. I think for women businesses, it is, first of all, the stereotyping, right? Because running a business is hard, right? It is, it takes a lot of commitment. So the truth is, again, these are facts, especially a male investor who has no context, right? Who has no empathy. That's why if you don't have empathy with entrepreneurs, it's hard. You get it? To support them. It's hard for you to support them. It's the same thing. I'm a male fund manager, I'm talking to a female entrepreneur. All I'm thinking is she's going to give birth. You get it? She's too soft spoken. You get it? Those are things that I'm thinking about. Right? And like I said, they are very honest. Very honest. They will tell you as it is. Naturally, although it is changing sometimes. But ideally, they will tell you, they will not over-exaggerate, they will not say 10 minutes. They are risk averse. So they want, and that's why, at least in Uganda, you'll find them in manufacturing, less in tech. You get it? Because they want to do things they can control, grow slowly, steadily, profit very fast. They wouldn't even tolerate, even if they had the money, that is. They won't take debt, They'll be very cautious about debt. So those things pile up to make it difficult. And that's why I think there is intentionality from LPs, some LPs that are interested in development, to invest more in female fund managers. Female-led funds. Because a female fund manager will have more empathy. That's one. Secondly, yeah.
Might be a bit shallow
Mm.
because
Shark Tank.
like,
Mm-hmm.
but there are some realities there because they actually, after entertaining us, they can pick some businesses and go. But from that example and others like that, the female investors are still, they are also looking for money like the male.
Mm-hmm.
The business-minded investors are not about to be sold, whether they are female or
Or-
male.
Yeah, that is true. And again, those are facts, right? It is a fact that people have the perception, and maybe it is true that business is rough, right? And so if you're a female entrepreneur, of course, also understanding that is important. It is important to understand that, okay, I'm going into business and it's rough, right? And I think training yourself. When you are in male entrepreneurs, you're also an entrepreneur. You're not a woman. You're an entrepreneur, full stop, right? And so understanding that helps you a lot. Because like she said, this affirmative action also has its challenges. It has its challenges because then maybe they give money too easily and then they don't help you. You get it? Because you're a woman. So what they call advantage, because sometimes disadvantage is you. What we need is for funds generally to look at women as entrepreneurs, and then for the women to also look at themselves as entrepreneurs. Full stop. You get it? It has to be. Yes. You have a female co-founder.
The social
Aspect.
aspect is very important.
And very strong, yes.
Because we're coming from markets where women are not even pressured. We're coming in markets where women get married and look so awkward when they don't have. Like they're in families and you don't have kids. Like, what happened? Like you got married, we paid for your dowry and you're not putting anything on the
Yeah.
Biologically, when they are in that process, like, they need to focus on that to make sure that they pass through that process until okay. So
They will do some things.
let me put it in this way. Investors look at this.
Of course.
When they're putting in money, that is number two, not for us. It's not about saying that it's not that, but because you can't work on it. Let us be honest. The key thing from my experience, which you have realized, and I was thinking like that when I did this,
Yeah.
the more the business would be actually realized that this thing is good. But to the extent that investors invested some money that just created us big for to make sure that they when they move with their package in their hand. They move the package with the keys, the package with the what. So to just make sure that that package is also physical, so that they can use the work. But what they discovered is that in our societies here, people don't want to just leave their kids in nursery there. People want their kids to be there with their mothers. They are the people whom they trust that they can care their kids. To the extent that actually, sometimes when they think about it, they're like, she's the head of the department, that's great, but she's pregnant. Then immediately start to think about who's going to be the assistant, because also the law requires you to give her labor leave. Like, you are supposed to give her 3 months minimum. It's 3 to 6 months, depending on the way she has given birth. Now you look at yourself here and you're like, okay.
Budget.
So we have to give a return regardless of which particular thing which happens. Then immediately start to think about the actual. Let me get an assistant for this one. For this head of the department. Make sure that when she's away, there's someone who can work with that. Now, my point is that when you look at these things when you look at them, sometimes you think about them in office. But actually, we tend to forget that they originate from that. African ecosystem is way different from. I mean, you're talking about whites where even the husband and wife can argue that the husband is going to stay
Yeah.
and the woman is going to bring the food on the table. Here you talk about South Africa, like what? So who married you?
Yeah, I mean, and those are the realities, right? That we have to deal with. And so for that, of course, again, like I said, there are more and more funds that have a gender lens, right? Gender focus. So they are designing themselves, even their return expectation, right? Sorry, please, let's listen. Even the return expectation is condensed with that in mind, right? So I think it's a choice of, either I go for those kind of funds, right? Or I'm an entrepreneur, full stop, and I work around some. Again, it's difficult, like William said. So, yeah, I don't have enough empathy to give more advice beyond that. Yeah, so, of course, when you're done the matchmaking, the other thing that is important, if you're doing investment readiness, you'll have done a disservice if you don't prepare a business for due diligence right from the start, even before you get the first investor, right? And due diligence is basically someone is going to come to verify all the other things we were talking about. Say, okay, you said you have a good team. Is it good? You said you have governance in place. Is it good? Are there systems? You said customers like your product. Is it true, right? You said you have this. So that's what due diligence is about. It's about verification of those things. And I'm going to talk about the list usually that at least as a basic you should have. And I will also share that by email. Then once you're done, do intros and sit back, right? Do intros and coach the entrepreneur. Sit back and coach the entrepreneur. By sit back, it means don't become the entrepreneur, right? Don't pull out a pitch deck. You haven't talked to the entrepreneur and try to represent them, because the entrepreneur is always the expert in that business. The entrepreneur is always the expert. So don't pull out a pitch deck, you're pitching on their behalf. It doesn't work, right? Because the entrepreneur, first of all, won't gain experience, but also you're wasting time, right? Because the entrepreneur may be pitching it differently, you're also pitching it differently, and then maybe you create suspicion. By the time the entrepreneur is pitching, it's like, I heard this person say this. Get it? So just do high-level introduction. I have this entrepreneur, this is what they are doing. I think they're in a good place. Then do an introduction. Let them talk for themselves. You can attend the course to support them, but try to stay away from becoming the entrepreneur. Yes. Yes.
Normally, like online businesses, where you have people that are sometimes open both markets, extending the business which is they must go that way. And they have a so that it goes through the
To work.
the binding offer. Okay, at least it goes there with the non-binding offer. But you come here in our market, realize that actually it's not very to get non-binding offer. So from your experience, I don't know what would advise that from what I've seen. I see it working that sometimes it comes up step 3, then it was to step 4, or literally it comes out actually after even they have done due diligence on the different scores.
So this I designed it from the hub side, but from the entrepreneur side, usually before someone goes into the detailed DD, right, where they are coming to do site visit, you get it? They're asking for the details. Idea they should give you an indicative term sheet, which basically has, this is the amount we are looking at, this will be the terms we are looking at, right? It's not binding. What that does is that it helps you save time. If the terms are wildly off, you stop the conversation, right? You tell them. You don't just stop, of course. You tell them and tell them, I think the terms are not in line, right? Are these flexible? Understand the flexibility before, because due diligence takes time. And if you are going to accept every investor to do due diligence on you before you even have an indication of their term, you're going to get tired. You'll be doing due diligence throughout. And it's okay for the DD to go and then you don't get the money, right? Because they found something. You get it? That they didn't know or that is off. Not because of the terms. Because you should have known that before. Right? It's more straightforward for that. Nobody does the application without asking for interest rate. So even equity, at least think about, so how much are you looking at? What equity do you want to take? Yeah? What share? Or what percentage do you want? Those details. There is a very popular term that is usually a turn off for some investors, or at least for some entrepreneurs, or at least is important to know, which is the drag along and tag along clause. Right? Drag along, drag, right? What that means is that if the investor gets a buyer at some point, right? But the buyer, let's say they have 20%, but the buyer wants the entire business, or they want 50%, means that investor has a right to force you to sell. Isn't it? You see why equity is very difficult in this market? Will an entrepreneur accept such a term? A local entrepreneur building a manufacturing business. It is difficult, right? So that's what drag along means. I've gotten a buyer, me I'm an investor. I put money in your business. I have a buyer who says I want to buy that business, but your share is not enough. I want more. Drag along means I can come to you, the founder, and tell you, you know what, we have to sell. And force you to sell by law, by agreement. The reason why they do that is because it helps them exit when they have an opportunity. Because if they get a buyer and then you're saying, no, me, I don't want to sell my business, they lose the opportunity. The opposite of that is tag along. You could also say that if you get a buyer who wants to buy your share, I also have a right to sell alongside you. Yeah? Yeah, those are sometimes to look out for. I will also share a sample term sheet and a list of some common terms to look out for in an investor agreement or term sheet. Yeah, so when you're preparing a business for due diligence, these are some of the documents. I'm going to share this list. But we talked about business plan, we broke it down. So we have a financial model, we have a pitch deck, right? Those two. And sometimes people have an executive summary that is not a pitch deck. That would also be part of the business plan. We have financials, that is historicals and forecasts. Historicals, the financial model, the forecast can be part of business plan, but then there are the historical financials, right? Now that's where most businesses struggle, because by the time they come, they haven't been keeping records, you get it? Then when they realize they are needed, they put something together. So if you're an investor, that is an area to look out for. So me, I don't ask for audited accounts, because I know they are always wrong, unless the business is mature. But I usually ask for management accounts. Audited accounts, we have so many auditors that are willing to sit down and come up with something. It is so bad, so bad. You'll find a business that has raised a lot of money with obvious mistakes in the audited accounts, like totals. We looked at balance sheet last time, right? So someone will have a balance sheet that balances, but when you add, it doesn't make sense. So you have to be careful if you're investing. But those are things, again, you can perform due diligence to help a business as part of investor readiness before they go for the actual what? Due diligence. Means you have capacity, you need to have capacity to analyze, look at the financials, make a sense of them at least. That's why that session last week was very important. Because if you don't have that knowledge, it is really hard. You'll just be having stories. You talk about stories, but the gist is there, the numbers. Then the team. So the team, usually you have to have CVs or profiles of the team and the organizational structure, who does what, who reports where, right? The profiles are most important. The team profiles are most important. Now, one thing to do here, if you look at the ecosystem, at least for Uganda, most entrepreneurs are young, very young. University, just started a job, 2 years, I left out, started a business, very young, which is a disadvantage, right? But that's the nature of the ecosystem. So for you to make that team look a bit stronger is usually to surround them with an advisory what? Board. And that advisory board, if structured well and pitched well, can help cover the gaps on the team experience. Because if you say this team doesn't have a lot of experience, but they have a very strong advisory board. If they are in financial services, maybe they have an ex-banker, right? If they are in manufacturing, they have an ex-head of operations in, say, Luca Plastics, or you get it? That kind. So advisory board is not just a board you put together to checklist. It has to be very intentional if it's to play its role. Yeah? It has to be very intentional if it's play that role. Advisory board. And usually that's the board that can become the real board later. Yeah? So team, because otherwise you can't do anything about an inexperienced entrepreneur. But they have the passion, they have everything else, they just lack what? Experience. Then media, these are pictures, photos. Like I said, these entrepreneurs, sometimes when you tell them things, they don't understand. When you say good maize versus bad maize, what does that mean? You get it? The investors, yes. You get? When you say mobile money, you get sometimes even those things may not make sense. When you say the average kilometers between a homestead and the next health center is 10 kilometers, they'll say that is a joke. You get it? When you say these health centers don't have this and that, they don't understand. So media is very powerful, by the way. Pictures, videos, very powerful in creating context, right? Context is very important. And then lastly is the legal, which I think that is more straightforward. It's basically incorporation documents, licenses, tax filings, etc. Now, usually I will not reject a business immediately because they don't have legal stuff. In Uganda, legalizing is a process, right? There are so many barriers and costs. You get it? That it is a process. If a business is good, but all they have not done is these legal things, that is a good business. Those are things you can fix, right? So this is important. Of course, no one will invest if you don't have them, but they are not things that will create an obvious, like that will create a no from an investor. It will be, you have everything else, but go and work on ABC, right? And these are things we can also help the businesses progressively, such that by the time they are raising money, they have them. In fact, if I was giving a grant, I would give a grant for these things. Registering, you get a one-time grant, I would. Because I know the realities here. Things are difficult. Yeah, even things like tax, you have to take the entrepreneur slowly and explain to them why they need and make it what? Yeah, register. It's not, you can't punish them because they haven't registered with URA, for example. Because everyone fears what? URA. So then you teach them how to go around and manage taxes while complying. You get it? Yeah. So legal things are very necessary, but they are not a deal breaker in most cases. And it's your job also to translate that to what? To the businesses. Any questions? I'm going to share this checklist. So don't have to. Any questions? Yes, please.
I have a challenge in clearly being that financial projection document. I understand it, but some point becomes so technical that you will not know how to balance some things. Like you remember last time we would be confused on whether something is an asset or say for example you are renting. You're renting and then you are wondering whether you consider this as current or fixed asset. And at the end of the day, things cannot balance because you just have a confusion of things. So if someone has to get properly and clearly a financial projection document, given its key importance in any startup, so that at least when a startup comes, this is the first document you work with. Work on your projections and be as as real as you can. But how can you get the projection document perfect, like right? I've tried all trainings. It's only one guy who tried, teaching about it, but still it wasn't as good as you would want to understand.
Yeah, so doing projections is 3 skill sets. One is Excel, right? Is there anyone who has done the model in another tool? It's usually Excel, right? So there is Excel, formulae. The second one is accounting. You need to know what revenue is, where it is placed, right? That is accounting. We try to do a bit of it. And then the third one is strategy, which is where you pick the assumptions from. Business model, pricing, cost structure, right? Business model and strategy. Those are 3 things. Now, in my opinion, as a hub, focus your engagement with the entrepreneur on the strategy part, the business model. Make sure they understand the assumptions of their projections. If they do, then they should be able to understand the model. Primarily, that is like 80% of the job. 20% is the accounting in the sense that they can interpret the results. You get it? Their job, and even your job, is not to be an accountant really, but to be able to interpret the what? The results. Like we did on the board. I think I'll check if we can take pictures of that board and share it so that you have it. Maybe on your screen or something. You get it? So if 80% is the assumptions, because the investor will ask, how did you arrive here? You get it? Explain to me how you're going to grow your revenue by 50x or by 5x or 10x. So they need to know that to get this revenue, it was a factor of price and the quantity. Right? And I remember our price was this much. And this is how it was changing. Our quantities were growing by this. That is it, right? Those are assumptions. And then accounting again is to know that, okay, it is an income statement, it is a cash flow statement. Because when they ask, say, well, why are your assets growing? And someone's like, asset? You get it? That is also a turn off. The third one, Excel, they don't have to know that. It is good for them because then they may be, but they don't have to. It can be a template that you've done for them, meaning when they put the assumptions that they are confident in, everything else is calculated for them. Right? That is one. Secondly, that is now something, after they have put in the assumptions, they can now come to you and say, okay, go to the hub. Maybe the hub has someone with accounting or something that can now use the assumptions to calculate and build the statements. Isn't it? So focus on the assumptions. Because that is when the model is actually useful. Because they understand the strategy. And this model, if they do that, you'll find that the model is aligned to the business plan. And there'll be less inconsistent. Sometimes you find someone has a pitch deck that is saying something, the model is sensing something else, yet the model is supposed to be a translation of the strategy, what we call the business plan, into numbers. So with projections, that is it. Focus on the assumptions. Then use templates. Or, the assumptions is the most important thing.
And then maybe another thing which we found out very
They don't understand Excel, they don't understand PowerPoint. So do you chase them because they don't? You can invest $1,000 in helping them gain those soft skills.
how do you structure it when you're doing
So I think, of course, there you have to have a clause on redemption, especially if you are expecting the business to buy you out, right? So you need to have a clause on redemption, and usually the value of redemption could also be predetermined in terms of how are we going to calculate the value that I'll pay you to buy out your shares, right? In terms of whether it's happening, usually it's private. You know, these private transactions, it's difficult to know. But I've seen a number, I think even, I'm not sure about PAL, but I think they also do a couple of redemptions, PAL Capital. Yeah, so they might have more experience there. But really the concept is simple. We agree today when we are investing that you buy me out, and this is how we shall arrive at the evaluation. It could be we shall get an independent valuer, you get it? Or it could be we shall do net book value, balance sheet. Yeah, we can agree on that. If there are no questions, thank you so much. I hope we did answer a few things. I think we did. There are not so many expectations. Investor criteria and requirements, right? All investor criteria rotates around the things we've talked about. It is just the specifics. And I think like we tried ourselves, the way they design investor criteria is not different from how you designed it. They'll start with a strategy, say, okay, we want to have a $100 million fund, we are going to invest like this. And then that is what they use to develop the detailed criteria of which kind of investments they are going to do, right? And it comes from how they are designed. Yeah. All right, thank you. Have a good rest of your evening.